The Roman Empire didn't fall to barbarians. It committed financial suicide. For 500 years, Rome dominated the known world with the strongest currency ever created, the denarius, containing 4.5 grams of pure silver that merchants from Britain to Babylon trusted more than any other money. Then in 64 AD, Emperor Nero made a decision that would doom civilization itself. He reduced the silver content by just 10%. Sounds insignificant, right? That single act of monetary debasement triggered a 400-year death spiral that destroyed the greatest empire in history, vaporized the middle class, collapsed international trade, and plunged Europe into the Dark Ages. Today, your government is making the exact same mistake, not with silver, but with unlimited money printing that's already reduced your dollar's purchasing power by 98% since 1913. In the next 10 minutes, you'll discover the precise mathematical formula that killed Rome, why every attempt to stop it only accelerated the collapse, and most importantly, the 3 specific assets that preserved wealth through Rome's fall and will protect you through what's coming. Because here's what your economics professor never taught you. Empires don't die from external conquest. They die from internal currency destruction. And the pattern is frighteningly consistent. Welcome to Rome. 64 AD, Nero's 9th year as emperor, and the city burns. The Great Fire destroys 4 of Rome's 14 districts, and Nero seizes the opportunity. He'll rebuild on a magnificent scale, starting with his own Domus Aurea, the Golden House, a palace so lavish it consumes 300 acres of downtown Rome, with a 120-foot bronze statue of himself at the entrance. Cost? An estimated 500 million denarii, roughly $2 billion in today's silver value. There's just one problem: the treasury is empty. Wars in Britain and Armenia have drained Roman finances. The annual budget deficit exceeds 200 million denarii. So Nero summons his mint masters and orders the unthinkable. Reduce the denarius from 4.5 grams to 4.0 grams of silver. Just 11% less. Nobody will notice, he's told. The coins still look identical, still stamped with imperial authority. But Nero has broken a sacred trust that stood for 275 years. The guarantee that a denarius contains a specific weight of precious metal. Once broken, that seal never restores itself. His successors face the same dilemma: mounting expenses, empty treasuries, and now a precedent. Emperor Trajan, 98 to 117 AD, fights victorious campaigns in Dacia and Parthia, but expansion costs money. He reduces silver content to 85%. Emperor Marcus Aurelius, 161-180 AD, the philosopher emperor, faces Germanic invasions and plague. Silver drops to 75%. By 235 AD, Rome enters the crisis of the 3rd century. 50 years of chaos with 26 emperors, most murdered. Emperor after emperor debases further. Septimius Severus, 193-211 AD, drops it to 50% silver. His son Caracalla extends citizenship to all free men in 212 AD, not from generosity, but to increase the taxable population, desperately seeking revenue as currency collapse begins. Emperor Gallienus, 253-268 AD, presides over total monetary breakdown. The denarius now contains just 5% silver, a thin silver wash over bronze that rubs off in your hand, revealing the fraud. Prices explode as merchants realize Roman currency is becoming worthless. Emperor Diocletian, 284-305 AD, attempts price controls with the Edict on Maximum Prices in 301 AD, fixing prices on over 1,000 goods and declaring death for violations. It fails spectacularly. Goods vanish from markets as producers refuse to sell at enforced prices below costs. By 312 AD, Constantine abandons the denarius entirely, introducing the gold solidus. But the damage to trade, trust, and prosperity is permanent. By 270 AD, the mathematical collapse is complete. A Roman soldier earns 225 denarii annually in the year 260 AD, barely enough to survive even then. 10 years later, in 270 AD, the same soldier receives 50,000 denarii. Yet he's starving because bread now costs 10,000 denarii per loaf. The currency hasn't just declined, it's achieved hyperinflation. A middle-class Roman merchant named Gaius Aurelius, recorded in a surviving papyrus from Egypt, describes his family's destruction. In 250 AD, his lifetime savings of 30,000 denarii could purchase a comfortable villa in Ostia, 8 years of food and marriage dowries for his 3 daughters. By 275 AD, the same 30,000 denarii buys 2 weeks of bread. His daughters remain unmarried because dowries are now worthless. His villa, foreclosed and seized, multiply Gaius by millions. The Roman middle class, the backbone of empire, simply ceases to exist. The crisis spreads like plague. International merchants refuse debased Roman coins, demanding payment in gold or goods. Trade routes collapse. The Silk Road traders in Parthia reject Roman currency entirely by 260 AD. Germanic tribes along the Rhine frontier refuse to trade grain for worthless silver-washed bronze coins. Cities shrink as urban populations flee to countryside, where food can be grown. Rome's population crashes from 1 million in 200 AD to perhaps 500,000. By 270 AD, the sophisticated, monetary economy that took 5 centuries to build disintegrates in 50 years. Wages become meaningless as debasement outpaces any nominal increase. Emperor Aurelian tries restamping coins with gistixi, 21 parts bronze to 1 part silver, thinking transparency will restore trust. It doesn't, it just confirms the fraud. Mints themselves riot in 271 AD, when workers realize even they can't afford bread with the money they're making. Tax collection collapses because nobody will accept payment in debased currency. So the government requisitions goods directly. Soldiers confiscate food, animals, supplies, turning taxation into armed robbery. Military discipline breaks down as unpaid soldiers mutiny or turn to banditry. Germanic tribes invade not just for conquest, but for survival. The only way to get real wealth is to take it from those who still have any. Plague spreads faster in a breakdown economy, without resources for public health. By 280 AD, the empire has fractured into 3 separate political entities, each issuing its own worthless currency. The formula is complete. Debasement, inflation, economic collapse, social breakdown, military failure, political fragmentation. Constantine reunifies the empire in 312 AD, but he rules over ruins, not the civilization that once was. The engine of prosperity, trusted currency, is destroyed, and with it, Rome's greatness. Sound familiar? It should. Since 1971, when Nixon severed the dollar's last link to gold, the United States has followed Rome's playbook with disturbing precision. The dollar has lost 98% of its purchasing power. Not quite Roman speed, but following the identical formula. The Federal Reserve has expanded the money supply by over 800% since 1971, while GDP grew only 450%, meaning massive currency dilution without proportional economic growth. This is debasement with a printer instead of copper mixing. The parallels are exact. Rome debased to fund wars and lavish spending. America prints to finance trillion-dollar deficits, foreign conflicts, and expanding entitlements. Today's U.S. national debt exceeds $36 trillion, with annual deficits topping $2 trillion. Unsustainable without monetary manipulation. Rome instituted price controls under Diocletian that caused economic paralysis. Modern governments propose rent control, drug price caps, and anti-gouging laws that create identical shortages. When California imposed rent control in 2019, housing construction dropped 30%. Diocletian's ghost laughing. Rome's middle class dissolved as savings became worthless. Today, American savers watch their purchasing power evaporate earning 0.5% savings interest against 3 to 6% inflation. Negative real returns, destroying wealth silently, just like Gaius Aurelius experienced. International traders stopped accepting debased denarii by 260 AD. BRICS nations, Brazil, Russia, India, China, South Africa, are actively building alternative payment systems to reduce dollar dependence, dedollarization accelerating. Oil traded in yuan, gold, and digital currencies increasingly bypasses the dollar, just as Silk Road merchants bypassed Roman coins. The timeline is slower. Rome collapsed in 250 years of debasement. America is 53 years into fiat currency, but the mechanism is identical. In 2023, regional banks failed. Silicon Valley Bank, First Republic signature. When their assets couldn't cover liabilities, echo of Roman banks during currency crisis. The same mathematical impossibility, promises denominated in a currency being actively debased. History shows the endpoint. When citizens lose faith in currency, economic complexity collapses, trade regionalizes, living standards plummet, and dark ages follow golden ages. Rome took a millennium to recover. The question isn't if the pattern holds, it's when. So how do you survive when your currency follows Rome's path? 3 specific strategies that worked then and work now. First, hold what cannot be debased, the eternal assets. Roman elites who survived owned productive farmland, income-generating real estate, businesses, and physical gold, assets that retained value across currency systems. When Constantine abandoned the denarius in 312 AD, landowners transitioned seamlessly to the new solidus because their wealth wasn't denominated in the dying currency. Today's equivalent, allocate 20–30% into hard assets, physical gold and silver. Rome taught us these survive currency death. Bitcoin as digital scarcity, algorithmically capped unlike fiat currency. Dividend-paying stocks in companies with real assets and pricing power. Rental real estate generating income streams. Commodities with inelastic supply. The key insight: these assets appreciate in debasing currency terms, not because they're getting more valuable, but because the measurement unit, your currency, is getting less valuable. You're not growing wealth. You're preserving it against monetary destruction. Second, become a strategic debtor in dying currency. Rome's rich got richer. Romans who owed debts in 260 AD denarii and repaid them in 280 AD denarii paid back perhaps 5% of real value. Inflation destroyed their debt burden while preserving their assets. Lock in long-term fixed-rate debt against appreciating hard assets now. A 30-year mortgage at 7% seems expensive, until inflation runs at 6 to 8% annually, making your real debt cost near zero or negative. This is wealth transfer from lenders, who get repaid in depreciated currency, to borrowers who locked in rates. The wealthy understand this instinctively. The middle class pays off mortgages in appreciating dollars, doing the opposite. Third, develop collapse-proof skills and decentralized income. When Rome's monetary economy collapsed, those with practical skills, farmers, craftsmen, physicians, soldiers, survived by trading direct value. Those dependent on currency-denominated salaries starved. Build income streams not dependent on one failing system. International client bases paid in multiple currencies. Remote work capability allowing geographic arbitrage. Practical skills, medicine, engineering. Trades valuable in any economic system. Business ownership with real pricing power. Multiple passive income sources. Position yourself to profit in any monetary regime. Dollar dominance, dollar collapse, digital currency transition, or barter economy. The Roman merchant Gaius failed because his entire wealth was denominated in dying denarii. Don't be Gaius. History doesn't repeat, but if you don't understand it, it will crush you all the same. Subscribe now, because next week, we're revealing how the Knights Templar invented international banking during the Crusades, became wealthier than kings, and why their sudden destruction in 1307 offers a warning about trusting centralized financial power. The pattern is always the same, only the names change.